This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with a very skilled investment pro about a few niche markets. Jay Nyack is Director of Fund Selection at Yieldstreet. Before Yieldstreet, he was with Cowen, where he invested portfolios for $10 billion of institutional investor assets. Jay also held roles at J&C Consulting Group, Guggenheim Securities, and International Partners. He received his BA in Economics from UC San Diego, an MS in Real Estate from New York University, and an MBA from also New York University. So, Jay, this is a really good time to be here with the uncertainty in the markets, and your oversight experience is going to be great. So, you all have a significant book of business in private markets. So maybe we could start there. So how are you all thinking of the private markets right now?
First off, Rob, it's really great to be here with you today. I've been really looking forward to this conversation. So to us, the private market story really starts with the investor and the menu of investment opportunities that really work best for them. And I should also kind of kick off with a little bit of context around what we focus on and who our investors are, because it really shapes our specific view of the world. Our investors are individuals and families that have achieved success, but may not quite have reached the point where they can get access to the types of opportunities that your listeners and members well know can enhance returns and better diversify risks next to what they already have. And what they already have, I can best describe as a very limited bar menu, generally of publicly traded stocks, bonds, and cash. So as we're thinking about the private markets and our investment program at large, we want to bring forward opportunities that really solve needs of our investors and bring forward opportunities that diversify and enhance returns relative to what they already can get.
Okay, so there's been a lot of interest in the sector for a couple of years. With CFA New York, we had a massive amount of content covering private markets also. So can we drill down a little bit on your view of the market then?
So going back to just our fundamental mission of unlocking opportunities that enhance return and diversify risk for our investors, we naturally looked at private equity, private credit, real assets, and other specialized asset classes for several key reasons. First, we embrace inefficiency. One real example that I love is if you look at like a building in real estate, two investors can perform their own independent diligence and compile their own information on that single asset and come to very different views of what that building can be. They can ask questions around whether the building is at its highest and best use, how effectively it's being positioned in the market, whether there are tenant improvements or capital expenditure needs that are needed, and what is the best deal structure for the asset. And they could arrive at, after asking those questions, very independent views and distinct views of what the answer may be for them. And this leads us to the next reason that really gives us conviction around the private markets. With this inefficiency, specialization truly matters. Mm-hmm. We fundamentally believe that experience, resources, process, and execution can truly add economic value and translate to compelling return potential for investors. And there's so many areas that this specialization can be expressed. It can be where deals come from and how they're sourced. It can be the depth of diligence that's performed to arrive at a stronger or differentiated view on an investment opportunity. It can be, shaping the structure of a deal and taking a different lens to how the deal should look and the shape it should take. And ultimately, and I think very importantly, is execution. What you can do with the asset once an investment is made. Mm-hmm. I should also add that this specialization is very important because it can be applied in so many different areas, including very specialized and very narrow sub-strategies. For example, GP stakes investing or sports and entertainment investing, both of which we're very constructive on, and that specialization truly matters in delivering very compelling return potential for investors. And the last piece that I mentioned, the execution part, is especially important, at least for me. With the utmost respect to our friends in the public markets, there's a different level of active management that you can achieve and get exposure to in the private markets. If we think about, for example, a private equity buyout investment, an investor can shape and change the strategic direction of a business to be on a more sustainable path. You can take products to new channels. You can create products by emphasizing R&D. You can acquire businesses that may be complementary to the core business of your own company. And you can sell non-core divisions of your business to a more natural buyer. So there are a lot of active steps that you can take to manage an asset, reposition the asset, and put it on stronger footing to maximize the potential of that asset as you look to sell it ultimately.
Okay, so these are the types of things and the types of assets we can get very focused on and lose some long-term goals. So could you talk about how you think a long-term investor should view this sector?
Sure. So I would reframe your question just slightly in how should any investor think about private markets investing? The first thing I would think about is at the asset or the company level, investors of private markets should really view time as an asset. So conceptually and academically, we have learned and we speak to how private markets investors look for an illiquidity premium or an extra return in exchange for making investments that are not freely traded on an exchange. But to us, we view there being so much more than that. There's an ability for an investor to zoom out and take a longer term perspective on a company or an asset and use that longer term perspective to unlock the ability to drive value and the potential of the asset over the long term. And that can have a very transformational impact. So, maybe said differently, without short-term earnings or stock price pressures, a business can consolidate its focus on core competencies. You can take, strategic investments to reposition the business to be more sustainable on a long-term basis. You can solve for or adapt to operational headwinds that may impact a business. As just a few examples of being able to zoom out, take a longer-term perspective to derive and generate economic value in many ways that a stock investor or the stock market as a whole may, adversely view some of these actions.
That's all really good strategic level, high level things. Now, there is something that's been changing in the market recently, and that's the cost of capital. This is relatively short term, but do you all view this as a temporary thing or a secular change or something in between?
As we think about the journey we've been on over the last several years, I wouldn't necessarily characterize it as a secular change as much as it's just a very rapid and dramatic change, the effects of which will be secular over the long term.
Okay.
And what I mean by that is we have just undergone and are in the midst of actually a Fed rate hiking cycle that we have not seen, the pace of which we have not seen in over 40 years.
Right.
And with that, there's been dramatic consequences across the global capital markets and across all asset classes. And so we've seen markets in the public markets really trade down as a result of some of the actions, including some other macroeconomic events that have occurred in recent years. We've seen a slowdown in transaction activity and financing activity in the private markets. And really, as we just kind of zoom out to the journey we've been on, markets are really trying to digest the pace and speed of the action, but the consequences of those actions truly are secular in nature. We believe that this is a generational change in the cost of capital, much akin to what we saw 40 years ago.
How do you reckon that this change is different than the one that was experienced by people in the US 40 years ago when we had a similar but less speedy change?
Sure. So I would say, what is just remarkable is the pace and magnitude at which rates have increased, the likes of which we have not seen in over 40 years. And when we think about, how the world has evolved since that time, information availability has proliferated, compute and analytic power around the consequences of some of these actions as it translates to industries, economies, countries. There's just a lot more tools to analyze the implications of these events, also to anticipate or respond to some of these events, especially at the magnitude and pace that we've seen some of these changes occur. But as we think and pivot forward, we think there is a significant opportunity created by the change in the cost of capital. And we think that this might have long-term implications, which really also reinforces our view of the private markets. as the cost of capital is significantly repriced today and in the midst of repricing, we think that creates increased return potential across all asset classes, but very much so in the private markets. And so for investors that are able to invest and have dry powder to be able to invest, we think these are going to be spectacular years for investors to either start their investor journey or in the private markets, like many of our investors, or to continue along on a strategic path along their private markets journey to capitalize on this market environment that's been emerging and that will persist for a period of time.
Okay, now that's real interesting. Maybe we can just dig down into that for a second. It sounds like you think that the private markets are a better opportunity than, say, the public brethren at this time. Why do you feel that way?
So I would view different assets as serving a different role for an investor's portfolio. So I wouldn't necessarily say that I would prefer one asset class over the other, although I do have my biases in that I'm very, constructive on the performance potential of the private markets. But the way I kind of think about it is each investment has a different role within a portfolio and serves a different function to work for the investor and what their individual objectives are. When I think about the market environment we're in today and private markets, we've had a significant tailwind for a period of time within the private markets that has supported the growth of the asset class. When I think about, earlier in my career, our pipeline and forward calendar of opportunities was about on a global basis was about 4,000 funds. When I look at my forward calendar and pipeline today, it's over 7,000 funds. Right. So we've seen that tailwind translate into increased transactional activity, a growth in the number of sponsors that are in the market, expansion of the types of strategies and increased specialization of many of those strategies. And so we've seen, a very sophisticated toolkit come forward within the space around private markets investing, whereas much, much longer ago, it was more of a cottage industry of a few narrow players in the space. As we pivot forward and we think about the opportunity set today, one, you have a Fed-induced or central bank-induced repricing of capital. I think that creates a tailwind for new capital that's being deployed in the private markets. I also think that the wave of activity in the private markets over the last couple of decades will really support and has created some of the muscle memory and the connective tissue to bring a very institutionalized, very sophisticated toolkit to this opportunity set to be able to generate very compelling returns for investors on a go-forward basis. And for us, the mission is really to bring that opportunity set to a new cohort of investors and also educate them about what these investments are, how they fit within traditional investments that they look at, and how all of these investments fit together and the role they play within a cohesive investment portfolio.
Okay, great. I do want to circle back to one thing, and that's sports and entertainment. And for those of you who are listening to this podcast, framing timing is real important. So we are at a stage now where we are a little bit shorter than 1 month before the 2023 Super Bowl. So that'll give you some idea of how the NFL's marketing machine is cooking right now. So now you all have a really deep bench in this area. And I read some stuff about your view that the sports and entertainment market is an emerging subsector. So could you define that, please?
Absolutely. So I would say first, and just to provide a little bit of context, when we think about private markets investing, the key tenets are inefficiency, just sophistication of the capabilities and the investors, and active management. And that leads us to some of the asset classes that I mentioned: private equity, private credit, real assets, and other specialized asset classes. And within each of those, there are very specialized segments that specialization really matters, and sports and entertainment absolutely is one of them. When we're thinking about the sports and entertainment ecosystem, we actually view it as an ecosystem. We think many of these businesses have traditionally transformed from more retail-oriented businesses. So think a sports team sells tickets and sells merchandise. Over time, these businesses became more so media companies. So there's TV and media rights, which has really expanded, especially into the live stream or the streaming platforms, both on a live and recorded basis. And that's really been a driver of value in the space. And as that ecosystem has become more sophisticated and involved and integrated, we're seeing many of these sports and entertainment businesses now transition into more technology-oriented companies. And that's driven more investor activity. It's driven up valuations in the space. And you see a cohort of investors with an extremely high degree of sophistication enter the space. So think institutional investors, private equity investors, high net worth leaders of private equity or private credit or alternative investment platforms, leading the charge to invest in these businesses, which is creating more of an institutional ecosystem around the businesses and more institutionalized financing, which to us translates to a very specific subsector within the private markets that we look at.
Okay. And those things come at a cost, so to speak, because there is higher pricing across the subsector. So how do you all view that pricing and how do you find value amid that?
Sure. So just to give some context around pricing and valuations in the space. So we've seen a dramatic increase in valuations for many of these businesses. As an example, if you look at the average NFL team in 2015, the valuation was about $1.4 billion, according to Forbes, whereas in 2022, it was $3.5 billion. The NBA, the average team and franchise in 2015 was $1.1 billion, now $2.5 billion. Yeah. So you're seeing a dramatic increase in valuations across all sports franchises. And that's really taken hold as transactional activity has increased, as the sophistication of investors understanding and wrapping their arms around the businesses and what they can do with the businesses. As the sophistication has increased, we've seen valuations and transactional activity increase as well. When we think about that context, that doesn't mean that we don't think an opportunity set exists. It means that we just need to be more disciplined about how we approach opportunities within the space. So as we're thinking about those rising valuations, one learning that we identified as we were digging into some of these opportunities is many of these businesses are very underbanked. There's very little financing, or there are very few lenders that have the specialization to provide financing for these businesses. Again, think about the complexity of a sports franchise that may or may not own their stadium. Right. They may have distinct media rights associated with their team vis-a-vis the league. You know, the relationship of either hard and tangible assets, media rights, and other economics associated with the operations of the business is highly complex and takes a lot of resources and process and institutionalization to be able to invest in the space. So that has translated to few lenders in the space that are lending. And so one area that we've gravitated towards is lending opportunities and credit opportunities in the sports and entertainment space. And just to give a little bit of context there, the average in the major sports franchises, the average LTV where debt is and has been applied is much less than 30%. Some, it's the LTV is around 15%.
Really?
So you're talking about billion-dollar businesses that in any other space, let's say of private equity, would be able, would be able to support a lot more leverage and debt, and has a lot of debt capacity. And because we're at the forefront of this being an institutional space within the private markets, there's an opportunity to bring good risk-adjusted credit opportunities forward within the space. And that's where we think some opportunities exist today.
Oh, that's fascinating. Well, perhaps we should leave it there because that is a nice place to have people follow up with you on what other areas they go. That LTV is very attractive, and I guess part of the reason there's not much lending in there is because a lot of the sports teams are owned by the wealthiest families in the world, around the world, and they financed it themselves, I guess, to some degree or another. But maybe we'll come back next year and see what the difference is as the media changes. So thank you, Jay. This has been a really interesting time.
Sure. No, my pleasure.
And so for those of you who are listening, as you know, you can visit our website, cfany.org, to hear all of our back podcasts. And I'll be back next week. Until then, I'm your host, Rob Rowan.